Mexican President Claudia Sheinbaum said on Wednesday that she and Canadian Prime Minister Mark Carney had agreed to strengthen trade collaboration.
And as countries seek other export markets, that's going to reduce the supply to U.S. markets.
The real cost of tariffs isn't just measured in dollars, it's trust, lost, and perhaps unrecoverable. Across global supply chains, confidence in the United States as a stable trade partner is wearing thin. Under President Trump's latest wave of tariffs, countries are no longer simply adjusting. They're rethinking their entire strategy. In Canada, that shift is especially visible. What began as a policy response to U.S. tariffs is now a national effort to reduce dependency on American goods, services, and even markets. Ottawa is strengthening trade ties with Europe, Mexico, and Asia. It's also prioritizing domestic production. The message is clear. If economic loyalty is punished, independence becomes a necessity. This erosion of trust is not just a diplomatic concern. It's reshaping where countries buy, sell, and invest for the long run.
And it is day 177 of the second Trump administration. And tonight, new inflation numbers are confirming what many economists have predicted, that Trump's tariffs would drive prices higher and higher.
For American consumers, the impact is now undeniable. According to the latest Consumer Price Index, inflation in June rose 2.7% year over year. Housing led the surge, but food, fuel, and durable goods also ticked up. Economists from Bank of America and Wells Fargo confirm what many feared. Tariff costs are filtering directly into retail prices. Yale Budget Lab projects that average U.S. import taxes could exceed 20% by August, an historic peak. Early year stockpiling delayed the pain, but that cushion is gone. As inventories run dry, companies are now restocking at tariff-inflated prices. That shift is beginning to show on the shelves.
As shoppers push their carts through the door, Urban Grocer is quietly pushing back, steering clear of anything grown in the U.S. Now that's been the case here for 117 days and counting.
Retail, that's a boycott.
North of the border, Canada's response is firm and deliberate. In British Columbia, a local grocer hasn't stocked U.S.-grown produce in over 117 days. What started as a modest cut quickly became a full phase-out. According to Nielsen IQ, American food product sales in Canada dropped 8.5% by volume in just a few months.
More Canadians come to America than tourists from any other country. Last year, Canadians made over 20 million visits to the U.S. and spent more than $20 billion here. But this year, many are not coming to America.
Tourism tells the same story. In June, car crossings from Canada into the U.S. fell 33%, the sixth month in a row of decline. In Vermont, resorts and breweries report a 30 to 50% drop in Canadian visitors. Some towns renamed streets and offered exchange rate discounts, but the absence is about more than pricing. To many Canadians, this is no longer a consumer choice. It's a political stance, driven by rhetoric they see as disrespectful and aggressive. Meanwhile, the U.S. market is feeling the deeper effects. As foreign suppliers redirect exports elsewhere, American buyers face fewer options and rising costs. Countries like Vietnam, Peru, Egypt, and South Africa are already filling Canada's supply gaps. Importers in the U.S. now face higher logistics costs, increased paperwork, and volatile pricing. And with more goods subject to tariffs, the ripple effects are spreading through manufacturing and retail. This isn't just a foreign tax anymore. It's becoming a domestic burden. President Trump points to rising tariff revenues, $64 billion in Q2 alone, as proof of success. But these gains come with growing inflation, trade distortions, and a widening credibility gap. Canada, led by Prime Minister Mark Carney, is emerging as a quiet but determined counterforce. Rather than respond with threats, Canada is playing a longer game, diversifying trade, reshaping supply chains, and building internal resilience. And that's where this all leads. The tariffs may raise revenue in the short term, but in the long term, they may cost the U.S. the one thing that made it a global trade leader: reliability. Because once allies start walking away, it's hard to bring them back.
Canada's new government will do several things. First, We will take a series of measures to stabilize our domestic steel market and prevent harmful trade diversion arising from current trade tensions.
When President Trump raised tariffs to 50% on Canadian steel in early June, the blow was immediate. Within days, exports collapsed, jobs were cut, and one of Canada's most tightly integrated cross-border industries found itself severed from its biggest customer. This week, Prime Minister Mark Carney finally responded, not with threats or retaliation, but with something more calculated, a structural shift. One designed not just to react, but to rebuild.
The trade actions of the United States are further transforming global steel market dynamics and supply chain. Let's be clear. Canada will be one of the countries most impacted by these developments.
The plan starts with a clear message. Canada will no longer be the world's most open steel market. For decades, nearly two-thirds of Canada's steel consumption has come from imports, while over 90% of its steel exports flowed south to the United States. Now, that equation is being rewritten. By the end of this month, Canada will implement strict tariff rate quotas. For countries without a free trade agreement, imports will be capped at 50% of their 2024 volumes. Anything above that will face a 50% tariff. For FTA partners, the cap is 100%, with the same 50% penalty beyond the threshold. A second, more targeted measure aims directly at Chinese origin steel. Any product containing steel melted and poured in China, regardless of where it's finished, will face additional tariffs. With one exception, U.S. steel remains untouched under existing CUSMA terms. This isn't retaliation, it's insulation.
So moving forward, we must diversify our trade relationships. And above all, we must rely more on Canadian steel for Canadian projects.
Rather than escalate tensions, Carney is using this moment to reorient the domestic market. That means investing, not just protecting. The federal government will inject $1 billion through the Strategic Innovation Fund. This money is earmarked for Canadian steel producers to modernize equipment, produce higher-value products, and fill the gaps left by lost U.S. contracts. To support workers directly, $70 million will be funneled through labor market development agreements, covering training and income assistance for up to 10,000 steel employees. An additional $150 million in regional support will be prioritized for steel-producing communities, alongside expanded loan access for mid-sized firms, lowering entry requirements, cutting interest rates, and extending loan terms from 5 to 7 years. But perhaps the most transformative change is in federal procurement. Going forward, government contractors will be required to use Canadian steel in major infrastructure, housing, and defense projects. From shipyards to bridges, the steel that builds Canada will now come from within. All of this unfolds in the shadow of Trump's tariff threats. Canada's position is precarious. A 35% blanket tariff on all Canadian goods is scheduled to begin August 1st, unless a bilateral deal is reached first. And yet, Ottawa has not retaliated. Instead, it's holding the door open, keeping tariffs off U.S. steel for now, while maintaining strategic leverage elsewhere. Digital services taxes have been paused. Canada has engaged in fentanyl coordination. Every move is part of a broader strategy to stay at the table, without appearing weak. Though the Prime Minister has acknowledged that no country has secured a deal with the U.S. free of tariffs under this administration, his approach suggests a pivot. The focus now is not on removing tariffs entirely, but shaping where and how they apply. The likely target is a reduced selective rate, 8% to 10% instead of 35%, with carve-outs for essential sectors like autos, energy, and metals.
Say we will continue to do business with the U.S. That's of the year, but we will also work with new partners or partners that we have not developed commercial relationship as deep as the U.S. one, including, of course, with Europe and key Asian countries.
Canada isn't just responding to a crisis. It's laying the foundation for a more self-reliant economy, one where steel is not just exported, but embedded in national development. This shift won't bring back every job. It won't reverse every lost shipment. But it offers breathing room and a pathway forward. Whether or not a deal is reached by August 1st, Canada has already begun to decouple its industrial future from Trump's unpredictability and place it firmly in Canadian hands.
You know, I grew up in Canada, where the entire trade mechanism is built toward trading with the United States. Canada is actively seeking to diversify its own trade relations. It's currently trying to finalize a free trade deal with a bloc of South Asian countries.
When President Trump talks trade, he talks about strength, about using tariffs to bring countries to the table. But as the summer of 2025 unfolds, something unusual is happening. The table is getting emptier. Yes, the talks are technically still on. Canada is negotiating. The EU hasn't walked away. Mexico is sending messages. But make no mistake, behind the press briefings and formal letters, America's closest allies are pulling back. And in the process, Trump's tariff strategy is not just straining relationships abroad. It's also hitting the U.S. economy at home. Hard.
This is America's biggest trading partner. Other countries are doing similar things. They're trying to figure out how to be less reliant on a trading partner that is unreliable and unpredictable.
After months of stalled dialogue, Trump's new round of tariff letters landed with a thud. 35% duties on Canadian goods, 30% on EU and Mexican exports, and 50% on copper, pharmaceuticals, and other sensitive items. The backlash was strategic. Canada accelerated deals with South Asia. The EU delayed its countermeasures but drafted a massive $72 billion retaliation list. Mexico continued talks but with reduced optimism. None of these countries slammed the door, but none are treating the US as a reliable partner anymore. Instead, they're working on long-term alternatives, and America is no longer in the center of their plans.
Past 3 months, this is when the tariffs went into place and companies either decided to absorb some of that, get inventory ahead of that deadline, or start to pass some of that on to the consumers.
While allies quietly pulled back, the real pain began showing up inside the U.S. economy. The 50% tariff on copper raised immediate concerns. The U.S. imports over half of its refined copper from allies like Canada, Peru, and Chile. But domestic refining capacity is limited. Tariffs only raised the cost, without improving supply. It was the same story with Brazilian coffee. With a 50% duty in place, prices spiked. But coffee isn't produced at scale in the US, except in Hawaii. Importing alternatives simply isn't feasible. American consumers bore the cost, with no gain in strategic security. Meanwhile, US companies and financial institutions began closely tracking the fallout. According to CBS News reporting, many businesses either tried to absorb the new costs, front-load inventory, or passed prices on to consumers. Attention also turned to household spending. Banks were watching whether American consumers, already stretched by inflation, were cutting back or falling behind on payments. Another area under scrutiny was investment. IPO activity and corporate mergers began to stall, driven by rising input costs and trade uncertainty. These developments raised questions not just about current earnings, but about confidence in the economy's direction. And as President Trump continued to publicly pressure the Federal Reserve to lower interest rates, especially around real estate, analysts noted that the White House was now seeking monetary relief to offset disruptions that its own trade decisions had helped create. Beyond immediate inflation and investment drag, a deeper shift is underway. The EU has signaled that its next wave of retaliation may target U.S. services, intellectual property, digital platforms, financial products. These are areas where the U.S. traditionally runs a surplus. If that surplus erodes, the U.S. loses not just income, but influence. Meanwhile, Canada is reviewing export permits for strategic minerals, including rare earths, copper, and uranium. Limiting exports to the U.S. would disrupt supply chains for EVs, AI chips, and clean tech manufacturing. According to projections from the IMF in June, a full trade breakdown with Canada and the EU could reduce U.S. GDP by up to 0.4%, with long-term investment loss in advanced sectors. What's emerging is not just a trade dispute, it's a structural split in the global economy, with the U.S. drifting to the sidelines.
Well, I think that's the key question, is what deal will be credible, will be sustainable, given the extreme uncertainty that's coming out of the Trump White House.
President Trump has argued that tough tariffs show strength. But what they've shown instead is isolation. While allies build new partnerships, the U.S. faces rising costs, anxious markets, and a weakening position in global trade. In the end, it's not just about how high the tariffs go, it's about how much trust is left when the dust settles. And right now, America's trading partners are quietly rebuilding a world that doesn't rely on Washington.